this is going to be a kind of in-discussion session between myself and Ida. So we've been trying to coax Ida across to this conference for a while now, but it sadly clashes with an event that the Aspen Institute run each year. And so this is the first time we managed to do it. It's great, Ida, to have you here. And we sort of said to Ida, why don't you come and do a kind of keynote? But if you know Ida like I do, you know that that's not really her style. She's much more of the conversational approach. So she said, no, we'll do it in conversation. So that's how we've wound up here. So I thought I would just start by asking you, Ida, to just say a little bit about the Aspen Institute and the Financial Security Program, just to give people some kind of context.
Thanks. It's great to be here. It has not been for lack of wanting to miss the last couple of years, but I know we've had great participation. So briefly, for those of you who aren't familiar with the Aspen Institute, it was founded in 1949 by a set of industry leaders post-World War II who wanted to have an ongoing place to think deeply, critically about values-based leadership and about creating a more free, just, and equitable society, both in the US and around the world, so that the kind of atrocities that happened in World War II didn't happen again. In many ways, it has become a real center point for cross-sector conversations around some of the most critical challenges facing society, and the Financial Security Program is one of a number of policy programs. And we tend to focus on what are the critical financial challenges, specifically, that are undermining household financial security, but part of that hypothesis is that level of financial security at the household level also sets the stage for the strength of the economy and democracy in many ways. So, a lot of our job is lifting up evidence-based insights, but also the ideas and the leaders in policy and market spaces who can solve those problems.
Great. And so, Ida, I think you and I first met in the context of sort of talking about the ways in which the UK has addressed the undersaving challenge and automatic enrollment, but actually, kind of more recently, as we've formed this research partnership we have, it's actually been some more forward-looking issues that we've come to find we have a lot of common ground on across challenges faced in the US system and in the UK system. So do you maybe want to just talk a bit about what are some of those issues that we've talked about and that you know are kind of similarly reflected on both sides of the pond, and we'll maybe use that as a way of getting into some of the stuff that's been discussed today?
Yeah, it's been a great, the partnership in some ways has paralleled the evolution of our program. So when I got to Aspen, we had a somewhat vibrant retirement security conversation where we had been looking at the fact that in America only half of the US population is covered in a workplace plan and other things like that. But my sense of Aspen as an institution, it was pretty under-leveraged in terms of looking holistically at people's financial lives. I don't think we're actually going to solve the retirement savings challenge for people who are retiring 20 or 30 years from now, unless we were actually looking at the context of their financial lives more holistically. So the work that we had stood up in we call it EPIC, the Expanding Prosperity Impact Collaborative. Sorry, I'm ignoring you all. I'm sorry about that. Hi.
I'm going to talk to these guys.
Okay, and I'll talk to these guys. So we do these 2-year deep dives into other dimensions of financial insecurity that there might be a ton of research on, but nobody's really tried to synthesize it, translate it, produce it for action. And so the first 2 years of EPIC, we looked at income volatility. We knew that it was rising year over year in trends, but nobody had really looked at that within year volatility and what are the dimensions and drivers of that. We've now are just completing 2 years of deep exploration on the issues of consumer debt, which is all of the forms of both loan and non-loan debt besides mortgage, that it's looking like that full debt stack in the American household, but I think a lot of implications here. And the next issue that we'll be diving into is housing affordability and stability, looking at the other side of the balance sheet, which is how do we address issues of adequate retirement savings or broader well-being when there's a whole part of the balance sheet that's about rising costs, at the same time that we're looking at people managing that with debt in more and more precarious work. So kind of putting that thing together and really challenging people who have been asked to solve specifically the retirement challenges of households to think more broadly about the role they can play in addressing these things that will come into context more and more as we look at savers in the future.
Okay, great. So I want to take a couple of these topics and get into them in a bit more depth. So let's start with the whole kind of emergency saving and financial well-being, broader financial well-being topic. Certainly here, as we've started to roll out the sidecar trial, I think it's fair to say that we found there's a growing sense among employers that this is a good topic to be thinking about, but it's still quite an early stage, and kind of getting employers to take this up is difficult and not necessarily something they've always spent a lot of time thinking about in the past. How's that dynamic in the States? Is there a market on the employer side for doing more with their employees beyond just pension saving, or is there a similar kind of challenge there?
Yeah, there's a growing awareness among employers. I think, look, in the US, the equivalent of your 500-pound statistic is our $400 statistic, that 46% of households couldn't come up with that without borrowing, or borrowing from friends, or taking out a loan. So there's an understanding of the pervasiveness of this lack of liquidity. But again, I think in terms of the role of the employer in doing that, I think there's more interest than there is action at this point. And so I think we're all exploring, how much of the role of solving this can be done through the employer channels in some ways. I would say the other thing that really does hit concretely, the broader set of financial well-being research that is coming out, that I think that you all are doing an incredible job in the UK with as well. That in the US, the Consumer Financial Wellbeing, or the Consumer Financial Protection Bureau, we did a lot of the work to actually come up with a consumer-driven definition of financial well-being for the Bureau. And, it's this combination, and this was across age cohorts, across race, across gender. This is a pretty strong and robust definition. It does have elements of choice and security in it. So the 4 dimensions for well-being were really that people want to feel in control of their day-to-day and month-to-month financial life. They want to be resilient in the face of an economic shock. They want to feel on track to meet their long-term goals. And importantly, they want to feel that they have the dignity and freedom to make choices that will bring their families more opportunity in the future. So all of those dimensions are important. I think that as that gets more and more into the ether, connecting the dots between emergency savings and long-term savings for folks are important. And we can talk about this, but I also feel like there's also limits to how much we can expect people to self-insure against all of their risks with their own personal savings. And so I loved to hear the conversation about insurance come up, and just other dimensions of this that we'll have to grapple with as a society of folks thinking about these issues.
No, that's great. And I guess similarly on the supply side of thinking about market solutions, I guess both in the commercial sector and on the sort of policy side, I know there's some interesting things starting to emerge on the emergency savings side in the States. You can talk a bit more about those, and what if any experience there is to share.
I mean, I would say on the supply. So in terms of there's experiments happening like there is with Nest. There's a few initial pilots starting to happen with connecting emergency savings with retirement. So. One company, Prudential, is doing a pilot. I think they have about 10 employers in a pilot they are doing. We know that the states, I often joke with Will that the US is a great net exporter of good retirement savings ideas. So David Laibson will say something amazing, everybody in Washington will listen, but we don't do a lot. But leave it to the UK to say, oh, that's a great idea, we'll actually know how to implement this. So our hope is that if we can import the great British accents back with us, it will sound like a wonderful idea that didn't come from home, and we can figure something out with this. It's our secret plan. But so there's some innovative work trying. The states have also been doing some of the great work on automatic enrollment, insights from behavioral economists. So there's 10 states now in the United States that are implementing or in the process of planning out some form of automatic enrollment. From the very beginning of design in each of those so far, the first $1,000 that would be saved is in a money market, a liquid savings option. So there's going to be able to look there as well to see what we can do. There's lots of limitations to the designs that we can do in the US because we do have the regulatory, the policy framework for doing our 401k, our defined contribution savings, really still puts the employer right at the heart of the fiduciary responsibility in a way that you don't have in a master trust system. And that is really part of what's happening with, smaller employers who we already know have day jobs and don't have HR functions, so they're not there. So I think it's going to catch on. I think that there's a robust set. I think this is where some of fintech can come in, quite honestly, about how do you actually maybe co-locate the services of retirement and short-term savings so that the user experience of that is holistic. But that the back end, because we've got different regulatory regimes for retirement and regular savings and different kinds of accounts and know your customer kinds of issues, that they may end up being separate products.
Mm-hmm. I should say, Ida's team and your former colleague David, who was here with us last year, did a great paper on hybrid financial products that reflects some of those ideas and is on the Aspen Institute website. Well worth a look if people are interested in that. Let's just pivot slightly then to one of the other sort of topic themes that's come up a bit today and that we've spent time thinking about, which is around contingent work and the self-employed, where we know that some of the traditional versions of automatic enrollment in the workplace don't necessarily apply, and so we tend to see lower participation rates. And you guys hosted an event in San Francisco a few weeks back that was starting to address this. So what are some of the ways you've been thinking about how do we get more of those people to save for their retirement?
Yeah, I mean, I think this is another place where the challenge is quite similar in the UK and the US right now. And there was the breakout I went to on the self-employed and retirement savings was, I think, again, similar to what we'd hear in the US. It's actually a very heterogeneous group, the self-employed, right? You've got your traditional small businesses, you've got entrepreneurs, but you've also got an increasing a group of individuals who are somewhat misclassified, where they're, for all of the ways that work is structured, they still probably want to be an employee, or the work that they did was primarily that of being a wage employee in the past, so that they may not come along with all of the same entrepreneurial proactive ways of kind of organizing things. And even in that case, we know that the majority of the uncovered in the US, as with here, are in small businesses and with the self-employed. A couple of things that we've talked about that are helping inform our work, we just did a paper on portable non-employment retirement benefits, which was PNERBs, is not a great acronym, but it's what we've got right now, so we're looking for a better name. But just again, the sense that if some of the policy changes that may happen in the US would pave the way for things that look more like a master trust, the ability of small businesses and increasingly perhaps the self-employed to pool into larger plans, which allow for lower costs and easier access. But so part of the future of the retirement system in our mind means in bringing in more and more of people who are in the payments and payroll space. So just like Ness already has an integrated API, what are the ways that we actually look at, especially for the self-employed or for small businesses, how might we kind of locate the potential savings opportunities on the rails of a system that they're already using versus trying to, just get them to sign up to a plan or have those plans just marketed to them, which is kind of the other thing that really we need and that you already have in some ways, but you had it for small business was, what's California is going to be a great example. California went live with their Cal Savers program on Monday, which is a version of an automatic enrollment. Every employer, 5 employees and above, has to now enroll in a plan or default into the state plan. Just like you saw in the UK, that creates a forcing mechanism for a decision that is not inertia. Right? So the forcing mechanism is now, am I going to be opening up a plan or am I going to default into the new plan? And that creates a market opportunity for industry as well as a new floor in terms of coverage. Oregon has done the same thing, but they went to 0 employees. So everybody has to make a choice in that case. So we're watching closely to see if extending that kind of forced choice for self-employed would be, but then again, the mechanism would need to be something besides the employer. So what are the other types of things? And that's where we've also, in that paper, explored what are the other kinds of institutions that either need to be created or could be appropriated, to offer this service to the self-employed. So you're working with IPSI. We now have an IPSI US. We've been talking with Etsy. We've been talking with a lot of the different platform aggregators of the employed. So I think this is one of those cases where neither place do we have solutions, but there is an increasing number of organizations who are curious about what their role could be.
That's great. I guess I want to touch briefly on debt, because I think this is probably an area where you've done rather more work than we have so far. And I guess, interested in any observations you have really about for lower income households, that interaction between debt and saving for retirement. But I suppose beyond any specific observations, just what's your feeling? Having done that work, what's your level of kind of optimism that this competing set of challenges can be squared for people in that demographic? And any thoughts on that really?
Yeah, a couple of things come to mind. We looked at debt, like I said, across the stack. And we have some solutions, some of which actually intersect in this Venn diagram of savings and debt and things like that, but other things don't. One thing I would say in the US case, it's not just credit. So we certainly don't ever want to conflate the idea that having credit is good. Having some kinds of debt is good. Other kinds of debt are proving harmful and creating long tails of financial precarity in people's lives. So, and increasingly the growth of non-loan debt. So debt that comes from unpaid bills, debt that comes from fines and fees, and the disproportionate way that kind of debt can spiral and get out of control for people. So that's an important piece to look at. Student loan debt in the US is a big piece of what's getting people's attention. No, it's not quite the same here, but certainly I think there are ways to think about aligning incentives between the providers of retirement services and understanding that part of retaining and attracting talent, especially younger talent, is going to be also helping them manage their debt. So somebody earlier talked about the role of financial advice. Certainly thinking about the kind of the ways that people's credit scores, manifest for them are going to be important. But honestly, I don't think that we've really tackled this in the U.S. yet either. I just think that it's going to be increasingly one of those things where what I'm heartened about is that we are thinking about them in the same sentence now. We don't have one group of people that are focusing on how do you get people to build assets and a group of people figuring out how do you either get people to consume beyond what they can afford, or thinking about debt and credit access. And so having more of these cross-reference conversations, I think, are going to lead to different kinds of solutions and different kind of collaborations. Great.
Okay, so fair warning to the audience. I'm going to ask Ida one more question, and then we're going to throw this open for a few minutes of discussion. And that discussion can be, we hope, pretty open. So interested in any questions you may have for Ida about what she's talked about or her work, questions that more generally have arisen for you in the course of the day, or just comments on some of the things that have been discussed today, because we're keen to hear back from people in the audience. And if you're really effective at that, you'll help Helen do her summing up by shaping, giving her some clues as to what other people have taken from the day. But while you think about that, I'm going to ask you first. So you've been here with us all day. We've had some different sessions. What one or two kind of things have really piqued your interest, or would you take away from the discussions we've had?
Yeah, there's a few things, especially in the last panel, and I was going to raise my hand, and then I thought, oh no, what would I say at the end? I'll just go ahead and mention it here, but it was a great panel. I think in terms of gender, the gender gap, the gender wealth gap, not just the gender pension gap, that's an exciting place. In the US, there's a new Women's Wealth Gap initiative that's really looking at the set of issues that create a larger and larger gap in terms of overall wealth. One of the things that you and I actually had talked about that's maybe an additional research question for folks in the room is there an additional dimension to the kinds of choices that women are making that contribute to that? So, and that is when you've got automatic escalation happening in this country right now, or the fact that you just have obvious changes in career where people get raises or where they have open access to different benefits enrollment. Is there a gendered way that women are making different choices than men? If you've got a shared head of household situation, are you actually doing your mental allocation across both budgets? So, you can say as much about this as me, are women tending to prioritize, I'll pay for childcare, you maximize your retirement, which may work out well in the short term, but may have implications in the long term. And so I think that there could be some really exciting work there. I also think that you all, in a couple of different places it came up, but certainly for us, we're really trying to figure out people's financial decision-making in the face of the rising costs of both dependent care and health care and housing. So part of addressing these financial challenges could be addressing these other pieces of what in the US we might call whack-a-mole, like what are people's budgets going toward that are really, if they're going to trade off, it's not going to be across those short-term pieces. They're going to trade off their long-term abilities to save and invest in their futures. How do we get some of the folks who are looking at some of those issues to bring it in? So those were a couple of the big pieces that I think were the piece. And then just really understanding, I think in terms of debt, we have something that, and this is international, we just did a health and wealth track at our Ideas Festival last week in Aspen. And medical debt and mental health and just debt and mental health are really at the forefront of issues. We had the CEO of GoFundMe, which is a fundraising platform, who has looked and made headlines in the US recently that a third of all of the fundraisers on his site are for debt or for medical debt. And so, what is actually going on in, this is about people's friends and family and pieces around that, but just really understanding and calling out these issues between financial security and debt and mental health, I think are pieces. And almost there's other countries, like I've been fascinated to look at, like New Zealand has one of the first well-being budgets. And when you look at the expenditures in this new well-being budget, the largest new expenditure is on mental health. Mm-hmm. And I think that a lot of the ways to address the mental health issues would be to understand the financial issues that are driving so much of people's stress and inability to have the cognitive bandwidth to think in the long term. So those are some of the things that I was really heartened to hear here, and hopefully in years to come we hear about some exciting new research and things that, again, can be actionable and leveraged by leaders who are able to think about product design and policy design.
Oh, thank you. And just to come back, actually, I think we were talking about this in the break, this question about how the household money management process may be split on gender grounds. You and I were talking to an employer last year who told us an anecdote about how when people make their flexible benefits choices each year, they observe that women in lower income jobs within the firm would tend to disproportionately direct their flexible benefit allocation towards shorter term things, including in particular cars in this case, whereas men in higher earning bits of the organisation would tend to put more into their pension. And so it's only one anecdote, but it's an interesting illustration of, when asked why this was, they said, well, it's because my partner does the pension saving and I manage a short term household budget. And so it kind of is an illustration of
you even see this internationally. It is understood in international development that the more that you can do microcredit or even micro savings with women, the more of that money directly goes into households and shows up as educational attainment and well-being of children. So I do think that there is a way that is just, that's being pulled through to household decision-making in the case of pension investing or not. But those are not appreciating, the kids are appreciating assets in the course of international work. I don't mean it like that, but I just mean that if we know these things to be true, how do we make it easier for different choices to be made? These incentives, I love the idea of not just sharing the work, but sharing the way that these incentives can be designed to ensure that we don't end up with disproportionate outcomes in terms of financial security in the long run.
Great. Okay, look, I'm going to throw it open for a few minutes because we're keen to hear some discussion points in it. So this could be questions, it could be comments, observations. I think there was one over here to start and then one down the front afterwards.
Thank you. Hello, Will Price from D3P Global. I wonder whether one thing we should think about more is consumption and contributions via consumption. So we obviously think about income and taking shares of income, and it becomes more difficult if you don't have a contract and it's more volatile. And we should never forget income. But there are some interesting examples. So in Mexico, if you have a unique ID, which you do, the regulator there worked with people like 7-Elevens and pharmacies with a price-controlled contribution. So you can make a contribution of $2, it's very cheap, and every time you make the contribution, or every time you go in to do your groceries, which you're going to do anyway, you can make a contribution. And I wonder whether, again, assuming you've got the ID and the IT, why not just do it as a national policy on spending? And is it 1% matched by the government, matched by, there's no employer, so you'd have to find it maybe just the person. And one of the reasons I think it's particularly useful is lots of the examples we've heard, the people are not the income earner, but they may well be the main spender in the household. And you don't need to get amazing data on income to understand when's the good month for you. The good month is when you make the spending, and you will do it, and then if the spending automatically leads to a percentage going, and it's all technically feasible, but I would just, as a sort of closing comment, say it's one of the ones, a little like we heard earlier, that you need to do it as national policy with some mandation around it, because you could do any number of great fintech pilots which would work, but unless you have it joined up to unique accounts and you get those small slices aggregated, it'll be lots of brilliant ideas that didn't add up to very much.
So, can I? Sorry.
Yeah, go for it.
So we, Ida and I, and the ICPM, which is a pensions organisation in Canada, jointly hosted an event in Vancouver a few weeks ago, and we had a panel on fintech, and there was a guy on that panel from an organisation called Miles to Retirement, which is Mexico-based, which is, I think, part of the process you're describing, and actually the addition on to what you just described is that they signed up retailers to also contribute, because it's a way of encouraging people to come and spend in those retail outlets. So actually you're getting it's a kind of save as you spend model where the match is coming from the commercial side in the same way as you might get Nectar points or cashback. So I think it's a really, really, really interesting idea, and one that probably could be pursued both at the sort of commercial level and at the public policy level. But I don't.
No, I think that's exactly right. He was fascinating, and I think the question is going to be, does that work for people? Is their mindset more aligned with spending and the liquidity need, or the retirement piece? What would we sort out in that space? And I would say that is another reason to watch what's happening with emergency savings that is separate than what's happening in conjunction with the retirement systems, the pension systems. So I know Greg was up here earlier. There's a lot of new investment in emergency savings broadly in the US. There's a lot of looking at prize-linked savings. There's a lot of ways of trying to figure out what are the right incentives to help people save their first 500, the ongoing pieces of this. There's just so much work in this space going on that should be learned from to inform future versions of Sidecar and other things there. But I think this issue of consumption and connecting to other micro points for savings reflects also what we saw earlier. Well, no, I'm saying this, but it was the self-employed, and it was interesting. Your data, Nest Insights data on thinking about saving a rate per day versus saving a rate per month, right? And you could say this more.
I wish that was ours. It was actually Shlomo Benazzi's data.
It was slow. No, but this was something. Where is your wonderful consultant that was doing that? So I'm quoting Shlomo instead of you. Oh, sorry. We have to work on that slide. But anyway, just other ways of thinking that if people's cognitive bandwidth is really focused on the short term, how do you leverage that opportunity instead of seeing it as a loss point?
No, definitely.
Right.
I think was there a question down the front here?
Hi, John Parker from Reddington. Thanks very much for a fascinating session. We've heard a lot of sort of what I'd say kind of bottom-up ideas today around how to encourage people to, be better savers or manage their finances better. I just wondered, and it's always struck me, the availability of credit debt is so ubiquitous, in both the UK and the US. It's so easy to take out a loan, take out a credit card, increase your balance, all that sort of stuff. I just wondered how much work you've seen around trying to control it from the top, getting the banks not to bombard you with, new credit card deals and, rollover deals, all that sort of stuff, because that, surely if you can obviously prevent people getting in debt in the first place, that is a good place to start.
Yeah, so we've looked less, there's a lot going on in the US around how do you structure how do you structure lending? So the ability to repay, do you cap interest rates? Do you cap the number of loans that could be out at a given time? Things like that. This is one of those places where it is hard to imagine the line between what is predatory and what is choice for individuals. And so I think we tend to we haven't focused as much on overall limiting credit, because again, there's so many kinds of debt that are actually productive for individuals, and and that there are kinds like some of the payday loans and some of the specific stack of debt and how you pay off different pieces of it, first or not, are difficult. So at the policy level, you've seen two different kinds of things. You've seen people try to cap interest rates, or try to cap, in the case of high interest payday loans, cap the number of them you can take out a year or the number of them you can have out at one time. Then there's if you're squeezing that part of the balloon, though, the other thing is credit's just going to pop up. Other kinds of credit is going to continue to pop up. It's so needed, especially in the context of kind of relatively stagnant wages, and for the US, a relatively poor safety net of any sort. That, now there's a lot of personal loans that are exploding online. If the state does it, then you've got internet that comes in. So, I think that part of this is going to be grappling as a society with this whole, I don't know, there's an economist and economic advisor, Gene Sperling, in the US, who was, with both the Obama and the Clinton Foundation's head of the Council of Economic Advisors. He just published a piece that I thought was really powerful on economic dignity, and this idea that economic dignity should be kind of the North Star for economic policy. So I think if you actually looked at a lens, and he has some conditions on that, like what that looks like, and he's going to be writing a book about it. But I think the kind of alignment that happens between what Dr. Leibson was saying up here earlier about nudges are not enough, with what my statement was back to him about, well, what's our end goal? Going to be, and then what's the role of policy and what's the role of innovation in getting there? I feel like we have to kind of break down the silos even more to have those conversations. And if we're going to break them down, I'd say one other thing that we are getting more and more used to saying on our team is that I do think that the 20th century, the innovation that happened, in a lot of democratic societies was ensuring against the risk of income loss. Most of the social safety net programs we had were about doing that. In the US, a lot of those don't work so much anymore. Unemployment insurance now works for 1 in 9 people in the state of Florida because of the ways that it's been changed. But if we're going to refix that for the next century, I think that it's ensuring against the risk of income and asset loss. I think we have to find ways to de-risk and democratize wealth ownership at the same time that we're looking at income, because increasingly, if labor's share of income is going to be declining, we've got to look at some of the other ways that we're addressing this problem. And so it would hopefully encourage us to think more boldly with a bigger toolbox about how we solve some of these problems, so that we can unleash people's productivity for economic growth. Because we're going to need every quiver, every arrow in the quiver to address economic growth stagnation in the future as well.
When Ida told me about the Gene Sperling article, I thought I know that name from somewhere, and I Googled it, and he was also a plot advisor on The West Wing, by the way, for anyone who like me, is addicted to The West Wing. I just really quickly just going to add, I think the point you raised had a great illustration in the behavior of the credit card company in David's study earlier.
Yeah.
Right, the institutional incentives around transitioning people from borrowing and consumption towards saving are a bit difficult. I think years and years ago I saw a bit of research, I can't remember where it was from, that suggested that there's about 10 times as much spent on marketing debt products as there is savings products in the UK. So it's a thorny challenge. Okay, we're technically out of time, but I think we've got a tiny bit of flex in the length of the final session. So I'm going to see if there's one more question or comment before I give the final word to Helen. Otto.
Thank you, yes. Otto Torresson, Chairman of Nest. Timing is everything, Will, isn't it? Come in at the end here, so I won't overuse it or abuse it. 2 or 3 comments. First, Tom Boardman, Henry Tapper, and Chris Hitchin and I are going to put a panel up here so you can see how things used to be. I think the contrast with what we've had today is remarkable. Brilliant. I mean, to see not just the gender diversity on show, but the diversity of thought and the diversity of subjects. Because for me, one of my big gripes about the industry has been its siloization of pensions as if it was a subject disconnected from everything else, and its ability to move the subject up to talk about the mass affluent and the wealthy, instead of talking about people who are just living their lives, you know. So I think you've managed to hold that together extremely well. But the question, I do have a question for Ida, because I was also struck by David's example of the credit card company that walked away. But the issue it raised for me was a different one, which was, if you're the board of that company and you're thinking about what a sustainable business model is for your business, apart from the fact that you should understand better what your business practices are doing to your customers, surely your impact on the vulnerable and people of modest means has got to be part of your view of sustainability. So just as the climate change agenda has moved solidly onto what does good practice look like for the planet in the long term, how can we get the financial sector particularly, because it's not just the financial sector, it has to be said, mobile phone companies are doing this too, how do we get those service industries to start thinking about their role in supporting a sustainable society, and that reflecting well on them as businesses?
Yeah, I'll do a short answer and we'll have a drink afterwards here as well. I am increasingly a little bit obsessed with how do you make sure that the conversations about financial security are a really central plank in a conversation about inclusive growth and inclusive capitalism. I think that the environmental, the ESG, the way that the metrics for the E of ESG have come into fruition, the ways that has gotten sticky and that there's become more and more investment vehicles that are aligned with investor values is important. We've had a number of conversations now in Aspen for the last 3 years on financial security metrics, you know, which is separate than just job quality, but how would you make the S of ESG as compelling, and how would you create investment vehicles that do that? So that's part of the carrot, right, part of things. I think the other is the stick, which is there will need to be some way that the policy and regulatory parameters of market competition create clearer boundaries about what is acceptable and unacceptable in terms of product innovation. We did a piece a couple of years ago looking across the country, across the world at the different kinds of regulatory sandboxes that were being stood up for financial product innovation. Of course, the Financial Conduct Authority was in the lead on many of this. In the US, most of the regulators, we have a safety and soundness mandate. That is what the regulatory bodies have. We don't have any mandates around competition or inclusion. Or what that means in that sense. So I think that it's going to be both, but that is starting to move. There's a couple of new groups. I love to say that regulatory innovation is not supposed to be an oxymoron, but it often is, because you end up with bank regulators that are very risk averse, you know, as they should be. But it does mean that sometimes they don't even understand what's going on in the fintech space. What are the potential new kinds of harms or opportunities that technology can drive, or even how technology changes the equation of where do we need to use carrots and sticks. So I think that the combination of, quite frankly, corporate and CEO leadership, whether through the B Lab movement or just the growing, you know, I think the tipping point for us is going to be that, for the US at least, people are scared that we may throw out the baby of capitalism with the bathwater because of the level of inequality that is starting to manifest. And the rise of populism in this country is not completely separate than the rise of economic insecurity. So if that can create some tipping points for additional leadership to start to really grapple with where do we start to recalibrate, that's a starting point. But I'd be open to ideas, and we're certainly building a table at Aspen where we can start to have some of the off-the-record, candid conversations that may push us in that direction.
Okay, well, that feels like a very inspiring place to stop. So I'm going to ask you all to thank Ida. Thank you very much.